Good evening, everyone. Welcome to our UCI alum homebuyer workshop. My name is Jason Maida. It's great to be with all of you this evening. Thanks for taking time out of your busy schedules to hang out with us for the next hour or so. This is a very interactive session that we provide to our alumni community. We do this 4 times a year to support really our local communities in affordable home ownership and provide you some tools and resources to help you on that journey towards home ownership. So we're going to get a chance to kind of share with you some information. Love to be able to answer your questions during this session. You can either use the Q&A or the chat within Zoom. I'll kind of be monitoring both windows so we can answer those questions on air. Make sure you get all the great information that you're looking for. And this, again, is very interactive. So as I go through tonight's session, we would love to be able to get connected with you. My name is Jason Maida. I'll be your host this evening, be presenting. And I work for an organization called APM. And we've been a strategic partner with UCI alum for over 6 years. And it's really a great opportunity for us to help the UCI alum community just to learn a little bit more about home ownership. And it's funny, just before today's session, I was actually working with one of your existing or your current alum that actually bought a home with us 2 years ago, and now they're thinking of refinancing their home. And so we were going through strategic ideas about like what does that look like for them and whatnot. So and that relationship started with a class just like you're going to be a part of this evening. So now our team focuses on education, but we also kind of focus on helping first-time home buyers really understand what their options look like in home ownership. Now, in tonight's class, we're going to go through these talking points, which would include what the housing market looks like today, including interest rates and some of the projections we're seeing out there in the marketplace. We're also going to spend some time looking at one of our tools. We call it a buy versus rent calculator to kind of frame up the differences between owning and renting. And then we'll talk a little bit about credit. That can be one of the biggest cost opportunities when it comes to your financing options. And then we'll include some different program options that you can look at as a first-time home buyer. And then we'll look at savings for home ownership. That can tend to be one of the biggest maybe hurdles for some of our first-time buyers is how do we save enough to help us get to that goal of home ownership? So I'll walk you through that, but I'm also going to walk you through some different first-time home buyer programs that can also assist you with home ownership. And then as we go through the end of tonight's class, we're going to talk about the workflow of buying a house. So after tonight's class, I may be a little bit interested in learning a little bit more. How do we go from tonight's class to kind of designing home buying options and then ultimately kind of finding the home and getting the keys to our house? So we'll go through the workflow. That'll be the very end of the class. You don't want to miss that part of that because I think it's really important to really understand how it kind of all comes together in the process of buying a home. All right. Now, I know some of you guys are getting tuned in now, just a lot of the room starting to fill up. One thing I did want to note that we are going to send out tonight's presentation out to all of the signups via email. So all of my slides for tonight, we'll get those out to you tomorrow morning. We're also recording tonight's class. That'll be up on our YouTube channel tomorrow as well, too. So if you want to kind of take a look back, you'll be able to kind of look back at the recorded version of this. You also have all the classes that we've taught with UCI available on the channel. All right. Okay, so let's talk a little bit about buying and does it make sense for me? And this is no doubt going to be one of the biggest financial decisions you have in front of you. And when we think about home ownership, there's a lot of great benefits that come along to it. Even in kind of a high cost of living market like we're in today, there's still opportunity to kind of control fixed expenses with housing when you're a homeowner versus waiting for the landlord to increase your rent because you know kind of what the fixed mortgage amount is going to be when you own a home. And even though some of our clients are buying in a kind of a higher rate environment today, even though rates are starting to come down, it is still a higher rate environment. Those homeowners, when they become homeowners, they will have an opportunity to refinance their home. In fact, that's the conversation I was having with one of your fellow UCI alum, like I said, just before tonight's class, looking at, I bought at this amount of interest rate, but now rates are down here. What is the opportunity to save money on a monthly basis by refinancing my home? Now, as our homes grow in value, and as we pay down our first mortgage, that now creates home equity for ourselves. And that really is kind of where the opportunity comes for us as homeowners, because this is now going to be a new wealth tool for us, if you will, that can really create generational wealth for some families. For most of us that are homeowners today, that's probably our number one asset next to maybe our 401k or maybe our retirements that we have, right? And there's also some tax benefits that come along with owning a home. The potential tax deductibility of interest that you have on a mortgage, which for most of us is a big deal with our returns, and the potential tax benefits that come along with maybe energy efficient upgrades you make to your home. So, when I think about home ownership for our first time buyers, it's really not fair to look at 2,500 in rent and say that's the same as $2,500 in mortgage because it just doesn't look the same. And to kind of illustrate that point, I wanted to share with you guys a tool that we have available to you. It's called our rent versus buying calculator. You can find that on our website. We also have some other calculators that you can take a look at, but we always like to kind of utilize this in our classes just to help you better understand those differences between, like I said, continuing down that path of renting versus what it could look like from an ownership perspective. For timing purposes, we went ahead and just kind of filled out this calculator, but I wanted to kind of walk you through the field so you had an understanding of it. I would encourage you after tonight's class, if you have some time, maybe dive into it, take a look around and see, what the numbers look like for you. In this scenario that we put together, we have an assumption of someone buying a house of say $700,000, and that has a minimum down payment of 3%. Now we're going to talk through down payment scenarios in our product segment in tonight's class, but the minimum down payment is 3%. That means I'm financing 97% of the purchase price, which would be $679. We put an average interest rate of 6.1, maybe a little bit higher than that, maybe closer to 6.25 with that level of down payment. We have a 30-year fixed mortgage, which is what most of our first-time buyers would do. And then we assume that we're going to buy the home in October. With that amount of down payment, we will have mortgage insurance. So we put that factor in there. We're going to talk more about mortgage insurance later on in our session tonight. And then we assume homeowners insurance, taxes. Maybe we're buying a condominium or a townhouse. If that was the case, we would add in homeowners association expenses. And then this is kind of where it's a little bit more personalized, but you have your tax bracket that you're in, and we put someone in a 25% tax bracket. How much is going to cost me to sell my home eventually? I'm sorry, the maintenance cost of my home, then selling costs for my home, how much my home will appreciate. And then looking at a scenario where I have a client that's spending about $3,500 a month in rent, and then the cost of renter's insurance that I'm paying. So that's an existing expense in today's scenario. And then how much I have my rent going up on an annual basis. So in this case, we had someone that's going to probably see their rent go up about $700 next year, right? So not unrealistic. And so what our calculator tells us is that, after 3 years, if we were to own a home versus renting again at $3,500 a month, it would make sense for us to buy after 3 years. I mean, that's like the break-even point. Okay. Now, really, it's the longer term play that we want to look at as homeowners is that, let's say 10 years from now. Well, 10 years from now, then it gets a little bit more interesting, right? Because now at 10 years, my gain opportunity of owning versus renting is almost $200,000. That's $197,000. So where does that come from? That comes from how much I'm going to save from a tax perspective. That's going to come from the equity appreciation in my home. So that is where that wealth really starts to grow when you start getting past the 3-year mark. And then, of course, the total home equity based upon what I paid my principal balance down and the home appreciation has almost $370,000. That is really what it's all about in home ownership. So, the reality is, does it take a few extra years to gain some equity in our home? Absolutely. When we think about buying a home, it's not going to be a turnkey thing where I buy my house and a year from now I've created this massive amount of wealth. It does take a little bit of time, but like everything, home prices do cycle, and interest rates do the same thing. But ultimately, long term is an amazing opportunity for generational wealth. Now, as we think about home equity, let's look at the housing market and what we're kind of facing today. The market all across the country, not just LA like we have on this slide, is starting to see a little bit of a crest and like a little bit of a move downward. Some of it's kind of seasonality. Some of it's just kind of what's going on in the geopolitical realm right now. But we're seeing homes stay on the market a little bit longer today, which is good sign for buyers. We're looking at this example here, which is very similar to other parts of the country. Homes median days on market, almost 2 months. We haven't seen that in a while. Especially over the last 2 years where homes were closer to like 30 days, average days on market. So that's encouraging. I think you see some buyers that are kind of waiting for the next shoe to drop with interest rates. So that might, nope. Sorry, sorry, we had a little test here in our offices. That's great for video. So sorry, we had a little fire alarm test after ours. So hopefully that does not disrupt our audio here for tonight's class. But to go back to the housing market, so when we look at what's happening right now, oh, sorry, hold on, we're gonna mute you guys out for a second. Hold on 1 second. Okay, sorry about that, everyone. We had an unexpected fire alarm drill at 6 o'clock Pacific time, so we apologize for that. All right, let's go back to the housing market conversation. And to my point earlier, we are seeing homes stay on the market a little bit longer right now. So you're seeing a little bit of a pivot right now. Previously, it was a seller's market, but we are seeing, as this graph would indicate, it's starting to turn into a little bit of a buyer's market. So as we're positioning ourselves in marketplace for whenever that time comes, there is some opportunities that are starting to come in the forefront for buyers. Now, there is seasonality to markets. Even in California, we see a little bit of a slowdown in the fall and winter time, but it's going to be interesting to see how we get through this fourth quarter. So October through December, I think it is going to be a little busier activity level from a buyer perspective. We're already kind of seeing that right now. Some of that is being driven by what we're seeing with interest rate activity. And interest rates have been very choppy over the last couple of years, but we're starting to see a little bit of a light at the end of the tunnel here in terms of interest rates, and we're starting to see a little bit of a trend down. We're watching really carefully what's going on with markets. Now, as we all know, we're in the middle of a federal government shutdown right now, so it has a little bit of a challenge, if you will, in terms of some of the data that's coming in as it relates to what the economy is going to do based upon that data. So we're kind of, or the markets, I should say. So like we haven't seen some of the employment numbers as of late because there's not a government to deliver those reporting right now. So we're kind of really watching to see when we get some data come in, what that's going to do to the markets. If you were paying attention to kind of what the stock market was doing, we lost almost 600 points today earlier in the trading day, and then we ended up going up. I think we closed at over 200 points up. So it's been a really kind of a interesting market. I will say we're watching really carefully to see what the Federal Reserve does with the next rate cut. We're some speculating that we could see 2 more rate cuts by the Federal Reserve this year. Now, when we think about mortgage interest rates and in anticipation of a Federal Reserve rate cut, we will generally see mortgage interest rates go lower. Now, what gets mixed in the news a little bit is that when the Federal Reserve makes that announcement, everybody thinks that rates are going to go down that day. Well, mortgage rates have already kind of baked that in. So usually a week to 2 weeks before the Federal Reserve announcement, we have a pretty good indication that they're going to cut rates. And you've already seen mortgage interest rates go down. We actually saw that as witnessed in the previous rate cut that the Feds just made 3 weeks ago, because rates had already gone down into the low sixes. Okay, and so that's why we're trying to get some clarity on what's the next move by the Federal Reserve, because that could help push interest rates lower here. And you can see, 3 weeks ago, we hit our 12-month low in interest rates, which is really encouraging. Rates are going to continue to go lower. It's not an if, it's more of a when. So the when game is kind of where we're challenged a little bit. There's 2 mandates by the Federal Reserve. That's for inflation to get below 2%. And then they're looking at what the labor markets are doing. And so that's why the employment data is really important, because that's going to drive the Federal Reserve's decision on upcoming rate cuts. Last thing I want to kind of just touch on here is that what we've seen in interest rates over a longer span of time, over 20 years, right? Looking back 20 years, and you can see these gray bars represent economic challenges. We have the housing crisis in 08 and 09, and we have the pandemic. You can see interest rates look very similar 20 years ago. You can see the cycle of interest rates, which I think is important. And I like to highlight what happened in the pandemic because, obviously interest rates were at all-time lows. Highly unlikely we're going to get back to that level. If we do, something really catastrophic has happened, right? So the average interest rate usually is in the high 4s to low 5s. That's generally what we see in the interest rate market. So as we look forward, interest rates are definitely going to go lower. Now, the effect that it has on buyer activity is where we have to kind of really figure out our timing. I know everybody wants the perfect storm, lowest priced home, lowest interest rates. Probably not totally possible. And it's really hard to time that, but ultimately it's really kind of understanding what your entry point looks like to get into the market that makes the most affordable decision for you. Now, interest rates are not the same for everyone. Things like credit score and eligibility, the loan program, how much I finance, what my down payment looks like. Am I paying points to buy down my interest rate? Now, really quickly, points are essentially paying additional funds out of pocket in order to bring down my interest rate. Usually 1 point is the equivalent of 1% to my loan amount, and it reduces my rate by 0.25%. I don't recommend doing a lot of the buy down stuff in today's market because ultimately the break-even point is about 3 to 4 years. So, it doesn't make a lot of sense to invest those funds at this point. Now, also loan term can also influence your interest rate. Generally, the shorter your loan term is, the lower the interest rate offering is. And as we get a chance to meet with our clients and go through a consultative process with them, we're going to figure out the right design for you. That's generally what I'm doing when I'm not presenting in sessions like this, is working one-on-one with clients to figure out what their home buying plan looks like for them, setting some goals and some objectives around home ownership. I know we had one question came in, which was just someone kind of joined late, want to know if we're recording the class. Again, we are recording tonight's class. And the slides that I'm taking you through tonight are also going to be shared out with the signups first thing tomorrow morning. And if you did tune in late, you might have missed our little fire alarm. That was exciting to get some different audio. And those thanks for kind of working through that with us. And hopefully you guys didn't get too distracted by that. Let's talk a little bit about credit. And credit's one of those bigger things that plays a role in the cost of financing in some of our product options. As you can see on screen here, we've kind of labeled some of the typical products that we work with clients and the minimum credit scores for each one of those products. Now, when we think about credit scores, there are 3 different models to credit scoring. There's auto financing, there's mortgage, of course, which relates to what we do, and there's auto financing in terms of credit models. Now, there's also 3 different agencies to credit reporting, and now you guys are all familiar with them: TransUnion, Experian, and Equifax. And each one of those give us a different score because each of them have different credit risk metrics that they use. And we're going to walk you through the mortgage score calculation in just a little bit. But when we think about those scores, we're always going to look at the middle score between all 3 of them when it comes to qualifying. So if my top score is 760, my middle score is 740, let's say my lowest score is 720, 740 is the middle score that we use from a qualifying perspective. Now, if I have a partner that's going to join me in the financing and we're going to file a joint application, and let's say my partner scores are slightly lower, maybe they're 720, 700, and 680. Well, they have the lowest middle score between the 2 of us. So that 700 score is going to be what we use for qualifying purposes. Okay. And so those are conversations we'll have during your consultation to figure out what the right design looks like for your financing. We're going to talk tonight a little bit about the areas of opportunity within your credit score, and I'll kind of take you through that. One thing I would just note to our class is that when you look at past events on your credit report, let's say late payments or maybe a collection account or something like that, the date that hits the credit report, usually within the 12 to 24 months of the event, that's going to have the big impact to the credit score. Now, as I move further away from the event, the organic improvement I see in my credit score. Now, this matrix here will show you how long the impression will be on your report. But to my point, it's going to be probably 12 to 24 months before we start seeing that uptick in the improvement for the credit score. Question came in the chat. I want to answer it for the audience, and then we're going to talk a little bit about the weighting for credit score around mortgage, which is, are you still considered a first-time home buyer if your partner, unmarried versus married, is not? What happens in this scenario? So we're going to talk about first-time buyer programs later on, but marital status doesn't have anything to do with eligibility for a first-time buyer unless you're married and you're living in the home that your spouse owns. Then you would not qualify for first-time buyer benefits. So if you're unmarried and you're living in a home and that person owns a home, your spouse, let's say, owns a home, but you're unmarried, then you could still qualify for first-time buyer benefits. But if you're living in a home that they own and you're married, then you would not qualify for first-time buyer benefits. All right. Hopefully that answered your question. Please let me know if I didn't, and we can come back to it. Let's talk a little bit about the FICO score calculation for mortgage. And what I'd like you to do is, as I take you through each one of these 4 areas, maybe it kind of sparks, an area of opportunity for you in your own credit score. So the first is the weighting is 15%. It's length of credit. So it's how long have I had credit? The more mature my credit file is, the better my credit score is going to be. So if I looked at someone that had identical trade lines, had 6 months credit history versus someone that has 6 years credit history, obviously the 6-year credit history is probably going to be a little bit higher, just because they have more seasoning in their credit file. All right. And then in use is going to be how much new credit am I trying to get access to? If I'm opening up a bunch of new accounts, am I having a creditor pulling a hard inquiry on my credit report? That is going to negatively impact my score. Now, hard inquiries, there's 2 different types of inquiries. There's a hard inquiry, there's a soft inquiry. A hard inquiry will impact your score. However, There are rules in place for mortgage and auto that allow you a 30-day window of time to shop with those creditors to make sure that you feel like you're getting a fair deal. Now, with our system and our process, we actually only start with a soft credit check at your pre-approval. The reason why we do that is because that allows you to confidently understand your financing and go out and shop for homes, but not having the impact to your credit score. Because most of our first-time buyers are going to be shopping in a very longer cycle time. Maybe it's 1 to 2 months. Sometimes it's 1 to 2 years. So we want to make sure we get you the tools without impacting your score. Now, this is probably the biggest area of opportunity for most buyers. It's around amount owed or credit utilization. It's basically how we manage our credit card debt. So when we look at that category, we're looking at credit limits versus credit balances. And ideally, we want to have our credit balances at 10% or less of the credit limit, which would be optimal level. Now, that's not always attainable for some of our buyers. Maybe we're currently at 70 or 80% utilization or percentage of our limits. In that case, we want to try to move those balances down to below 50% utilization. Then we'll see the uptick in credit score. Next level is 30%, and of course, 10% would be optimal. Now, let me give you a tip for our class in terms of how you can manage credit card debt and maximize your credit score. So if you look at one of your credit card statements, there's two dates. There's a billing statement date, there's a due date. The billing statement date is the date when the creditor basically closes out 30 days of activity on your credit card based upon payments made, charges made. So my tip for you tonight is if you can pay off that credit card or pay it down before the billing cycle closes, you're going to get a much improved balance that's going to get posted out to the credit agencies, therefore lowering your credit utilization and lifting your credit score. Especially if you're getting ready to apply for something, that's a great way to kind of manage down credit card debt. Last component, it's probably the simplest one, but the biggest impact is payment history. So if I've had a late payment, it's rated as a 30-day late, 60 days late, or even a 90-day late. The higher my lates are on that spectrum, the bigger impact I'm going to have to my credit score. All right. And especially in the most recent 12 to 24 months, that's going to have the biggest impact to my score. All right. Now, as we look at credit scores, we do to also take a look at some of the actual accounts that show up on the report. Student loans would be one of them. Before I go into student loans, I just want to take one of these questions really quick, and then we'll talk a little bit about student loans because it is a big topic of conversation in lending these days. Which the question I got from the audience is, how can someone compare interest rates between banks and credit unions without having multiple credit checks or hard inquiries? What can someone do to improve their credit score after late payments before refinancing? So, with comparing rates between banks and credit unions, by the way, I didn't mention this earlier, we are a direct lender. So we do all the things like a bank does. We just don't take deposits or do investments and stuff like that, or have brick and mortar in the communities. We are what he calls a mortgage banker, which is a direct lender. So we do everything a bank does without those other things. It's really hard probably to compare rates with banks and credit unions because most of them will do hard inquiries. From what I've seen in my experience, that's where I think we have a little bit more autonomy in our world to be able to still give you the information you're looking for with only a soft credit check. So every lender is going to do things a little bit differently. We just kind of cater more towards the first-time buyer, more towards more of a customized approach. And then the other question was, how can someone improve their credit score after late payments before refinancing? So if you're an existing homeowner and you do have the opportunity to refinance, the way we consult with clients, even with a purchase too, we can look at your soft credit score and give you some counsel without impacting your score and give you some direction. So oftentimes I'll meet with clients for a consultation, take a look at their credit report, give them my recommendations, and then we can set a credit plan in place to maybe tackle certain items that appear as impact items for their score, and then help them kind of get in the best possible position. All right. Okay, hopefully that answered your question. Now let's turn our attention to student loans. I just want to kind of bring this to everyone's attention because student loans are something we have to get visibility to because underwriting guidelines for loans do require us to take a look at what the actual payment's going to be and how they're being repaid. Now, many of you might still be in forbearance on your student loans. And if that's the case, then we still have to count a minimum payment for you, when it comes to qualifying for your mortgage. And if you're not in active repayment, and let's say you're applying for a conventional loan, then we look at 1% of the totals in student loans, which would, let's say I have $75,000 in student loan debt, then I take 1% or $750 as an assessed monthly payment for qualifying. If I'm doing an FHA loan, it would be 0.5% or $375. So That's if I'm not in active repayment, so forbearance or deferment. Now, if I'm on a savings plan and I want to use that payment for qualifying, I just have to be actively paying that. So if I have that same $75,000 in student loan debt and I'm paying $250 per month, that's what I can use for qualifying. Some of our clients are in public forgiveness debt. That is where you're getting forgiveness after 10 years. There still is active repayment on that. So whatever that payment amount is, that's what we would use for qualifying purposes. So I share that with our audience because student loans shouldn't be a hindrance to qualifying. We just have to better understand like where you're at and how that could maybe impact your eligibility. We're kind of in an interesting situation with student loans because we're seeing some student loans being transferred to different servicers, which can make it a little bit interesting. Forbearance, where we're not actively repaying for several years out. And so if you're trying to buy right now, we just want to kind of give you the proper guidance there. Before we talk about loan programs, I want to take on another question, really simple. The question was, on a one-on-one consultation, is there a cost for that? Absolutely not. So we just do that to inform our clients. That's just part of our services we provide as kind of the after part of today's session. So we'd love to meet with you for a one-on-one. So yeah, there's no cost for that. Okay, loan programs. We're going to kind of spotlight a few of them tonight. I'm going to just give you kind of a 10,000 foot look at those. And then as we meet with you for a consultation, we're going to figure out which one matches best for you. But we'll start with the first product, which is a conventional loan under Fannie Mae or Freddie Mac. You're hearing a lot more about them in the news because they're talking about privatizing them. They are kind of under U.S. government conservatorship right now. They set guidelines for the conventional loan through Fannie Mae and Freddie Mac, and then as lenders, we administer those programs. Minimum down payment for a first-time buyer is 3% with them. You can see the minimum credit score. Now, when we go over what we call the conforming loan limit, which right now is $806,000, we can go up to 3% down. But once we lift over above 806, that minimum down payment jumps to 5% down. That's called the high balance limit. So if you guys are in Orange County today and you really want to buy there, we can go up to that $1,209,000 figure. But if you're in San Bernardino County, San Bernardino maximum is 806. So it does change based upon the cost of living in the market you're going to buy in. The FHA loan, a little bit different. That is a government insured loan, 3.5% down payment, a little bit more flexibility in credit score and just general guidelines for the buyer. But it does come with a trade-off and expense structure. And we're going to talk more about that during our mortgage insurance segment in just a couple minutes. That is a government insured loan as well as the USDA product just below that. So those are all insured by the US or by HUD. And so, with both of those programs, HUD insures FHA, USDA is the USDA product. The USDA product is government insured, but it's more for rural purchases. So if I'm going to purchase a place in Joshua Tree, for example, I get a 0 down payment option. And it just has to meet that geography, but it also takes a look at my income by my household size. All right. Now, there was 2 changes to FHA and USDA because they are government insured products where you do have to be a permanent resident to access those programs. Now, if you're a non-permanent resident, that does not change anything with a conventional loan. It's just with these 2 programs, unfortunately, because they are government insured, has changed the eligibility for residency. The jumbo loan product is going to be not typical for first-time buyers, but is it in the suite of products? It's just allowing someone that needs a little bit more buying power to purchase beyond the agency limits. But it does come with higher down payment requirements, a little higher credit score requirements, but it certainly is available to our buyers. And then the VA product is for veterans that have eligibility for that program. It is a 0 down payment option. You can see the minimum credit score. There really is no maximum loan amount for the veteran. With that no maximum loan amount, there's just a lot more leniency for the veteran to get access to home ownership. Now, for first-time buyer programs, specifically in California and for most states abroad, basically all 4 of these programs will fall into a first-time buyer status. So depending on what state we're in, I think most of us are in California tonight, you can get resources to help with the minimum down payment as well as closing costs for some of those programs. We have a little first-time buyer segment that we'll do tonight as well, designed to talk a little bit some of the California resources that are available to you. Now, when you purchase a home and you decide to put less than 20% down on a conventional loan, or if you're buying using an FHA product, there's what we call as mortgage insurance. Now, there's 2 forms of mortgage insurance. There's PMI, which is private mortgage insurance. There's also MIP, which is for FHA loans or mortgage insurance premium. Now, with a conventional loan, with that minimum down payment that you learned a little bit earlier, the down payment will drive the mortgage insurance cost as well as how much I finance and what my credit score looks like. So the more I can put down, higher I can push my credit score, the cheaper I'm going to have from a mortgage insurance perspective. Now, what is mortgage insurance? Well, mortgage insurance essentially insures the lender that if the buyer defaults, they would be protected with that insurance. And it is consumer paid, but private mortgage insurance is basically 7 or 8 different private companies that insure the lender. When we get under MIP, it's all government insured. Now, with the PMI, as we see right here, there is a cancellation option. So once I have 2 years in my home and 22% equity, I can apply to have that mortgage insurance canceled. Now, if you've started your search already on Redfin or Zillow and you maybe use some of their calculators, they're a little bit, I wouldn't say deceiving, but it doesn't really paint the picture properly because mortgage insurance has these components built into it, and it's not as expensive as you might think. If we looked at a $700,000 amount financed and we had a 740 credit score with 3% down, we're just over $209 in mortgage insurance costs. Okay, it might look different in your online searches, so I'd encourage you to check out some of our calculators. They'll give you more of an accurate figure. Of course, I'll give you guys proper guidance on that when we get a chance to meet for your one-on-one. Now, on the FHA side, there's 2 forms of mortgage insurance. There's monthly mortgage insurance and upfront mortgage insurance with these factors. So it's going to be a little bit more expensive with FHA as opposed to conventional. With FHA, there is no cancellation option for refinancing. No cancellation option for mortgage insurance. You have to refinance in order to get out of the FHA mortgage insurance. We generally use FHA as a entry point to homeownership for those that maybe can't qualify in a conventional loan for a variety of different reasons. Maybe it's credit score, maybe it's amount of expenses, maybe it's just past challenges that we've had financially. So FHA can be a lot more flexible than, say, conventional. But ultimately, once we get into FHA, maybe in 2 or 3 years, we're trying to refinance over to a conventional loan. Now with FHA, here's what the option or the mortgage insurance structure looks like. You have your upfront mortgage insurance, and then the monthly mortgage insurance is going to be more expensive. So you have 2 forms of it when it comes to FHA. So one of the things I will say that I hear from clients a lot, and it's a little bit of a misconception with FHA loans. People see FHA rates. If you were to Google rates right now for FHA loans, they look a lot lower than conventional, but what's not being shown is the expense structure. It's a lot more expensive for an FHA loan as opposed to a conventional product. Generally, it's about 0.25% or more difference between the 2 product rates. And then question that came in before we talk about income was, is upfront mortgage insurance paid at the time of closing? Upfront mortgage insurance is actually built into your amount financed with an FHA loan. You can pay for it upfront. 95% of clients will just pay for it in their total amount financed. All right, let's kind of transition into income and expenses. We'll talk more about income first because I get a lot of questions from our classes and from our one-on-ones that I do with clients of, does my income qualify, or what are some of the documents I need to have? Well, let's first of all provide you some of the documents. You can see the documentation generally that we would request in the process. You can see that all on screen there. Now let's talk a little bit about eligibility. And so when we think about applying for a mortgage, we generally need to verify 2 years of history between employment and or education. So, the example I use for my class is like, let's say someone just recently graduated from UCI and they graduated in the spring and they just started their job here in August, right? Well, I have less than 2 years on my job, but I can use my employment and my education for the last 4 years of my undergrad to make up that 2-year gap. All right. So you don't necessarily have to be on the job for 2 years, which you may see in some of your searches. You can put together a history between education and employment as well. Also, at times, we'll have clients that maybe have been on their job for 5 or 6 years, right? But they have an opportunity to take on another job and or a new job, I should say, and they have an offer letter for that job. Well, if they have an offer letter, we can technically qualify them for their mortgage based upon the new projected pay they're going to have, depending on what the timeline looks like and their execution of that offer letter. So that's something that can be a game changer for some of our clients looking to purchase their homes. Now, there is a 2-year rule in place for self-employed individuals. So if I am self-employed, I do have to show that I've filed 2 years of tax returns as a self-employed individual. And what we do from a calculation perspective is we calculate the net income for that self-employed individual. We average it over 2 years. Now, if I'm in a position that has variable compensation, let's say I'm in the tech industry, right? And I have an RSU component, restricted share component, and I get, let's say, annual bonuses, right? If I want to include that variable compensation as part of my income for qualifying, then we have to show that we've been with that employer for 2 years because we have to show consistency of getting those types of earnings. And then we average that over 2 years as well, too. Same thing would hold true with overtime as well. So if I'm in an hourly position, but I get hour overtime, or maybe I'm a nurse and I work at UCI and I'm getting shift differential or night pay, cases like that, we do have to show a 2-year track record so we can average it over that span of time. And then another thing just to point out, if you have dual employment, so let's say you work for 2 different employers, then we have to show in that case, we've been working for both employers simultaneously for 2 years at the same time. And last thing, one other thing I want to point out, if you have maybe a side business, like let's say you drive for Uber or Lyft, but you also have a full-time job, and if we want to introduce that side business, that would also be a case where you have to show simultaneously 2 years that we've been working with both employers or have both the self-employment and the 40-hour workweek job. Last thing I want to point out on income is if you have a partner or a spouse that contributes to your household income and expenses, we can't introduce that income unless they're going to be part of the application. We get that question a lot. So if they're contributing $3,000 to monthly expenses, unless they're going to be a part of the application, that income essentially won't count towards the qualifying. All right, so that gives you a sense of income. Now we want to talk about one of the qualification metrics we use in lending. It's called the debt to income ratio. And before I do that, I think I want to see, let me take one of these questions. Ken's typing away on this, but I'll take it for the group, which is, what are the unnecessary fees I should look out for when applying for a mortgage? So I don't know if they say unnecessary fees. Sometimes they call those junk fees, if you will. In our working with clients, we're very transparent with our fee structure and everything, but there are some lenders that will charge significant amount of fees for financing options, which is not fair to the consumer. I think it's important if you're working with a lender outside of our team, I would say just ask the questions, what that's for. We have a very transparent pricing structure that we show with our clients when we meet with them for a consultation. By the way, just to kind of dovetail off that, because of our UCI alum partnership, we actually discount our services by $750, which shows up on your closing statement. So you guys will see that as well. So that's one of our benefits of working with us, either on a purchase or on a refinance. All right, so let's get back to what we call debt to income ratio. That's expenses versus income. Really simple calculation. We're looking at pre-tax income for our client versus what they have outgoing, as well as what they're going to have outgoing with their projected housing payment. So if today I have a personal loan and a car loan and a credit card bill, and then I also have my mortgage payment, that's going to be looked at versus what I have in total gross income. It's not take home, it's going to be gross. So if you look at our scenario on screen, we have a client that has $2,500 in projected housing expense, and then they have $500 in existing debts. Well, that person has $3,000 in projected expenses versus $8,500 a month. So that tells us that 35% of their gross income gets consumed by those expenses. And so when we look at the housing budget, it does include the principal and interest of the loan, what those property taxes might look like for the house, homeowners insurance, mortgage insurance if they're paying that. Maybe they're buying a condo and they have a $500 HOA expense. That all gets factored into the equation. And then, like I said, we take those existing expenses. Now, the sweet spot, I would say, for most first-time buyers, when we look at that percentage of income, is probably 33 to 36%. That's would be kind of the excellent level. Everybody does have a varying tolerance levels of how high they want their debt to income ratio. I mean, there's no secret that in some of our high cost of living markets, Orange County, LA County, some of the Bay Area markets, we do see higher debt to income ratios because of the higher cost of housing. But if you were to look at kind of the typical comfort zone is 33 to 36%, but our guidelines will allow us to go to 45, even 50%. So as we meet with you for your consultation, we talk about affordability, which is far more important than this calculation. We want to know what that looks like for you. What do you think you can afford? If I'm paying $2,500 in rent today, can I afford to go to $3,000, for example, with my current expense structure? All right. All right, let's talk a little bit about down payment for home ownership. And when we look at savings for home ownership, I kind of kicked this off in our initial part of our session today, which is, that's probably one of the biggest challenges for most. So I'm going to walk you through a savings plan in just a few minutes. But before I go through that, I want to just share with you just kind of the typical documents needed in verifying assets. And obviously, we can verify assets in checking and savings accounts. Cash deposits cannot be used. I will even kind of add on to that. Right now, digital currency or crypto cannot be used in financing. It's not adopted yet in guidelines. Those, and in fact, I had a conversation with a client earlier today. They have a pretty good holdings in crypto right now. The way that would work, we do have to have all assets seasoned 60 days. So if somebody's trying to use crypto and they're trying to prepare for home buying, they're probably gonna have to make the sale of that digital currency, move it to a cash position, have it seasoned for at least 60 days, and then they could use that for their home purchase. But large deposits and transfers, they all have to be sourced in financing. So that's just part of what we have to do in the lending side. But you can use 401ks, 403bs, those are all allowed. We would just encourage you before you use those assets or even a brokerage account, talk to your financial or tax advisor. And gift funds can also be used. That's where a family member is helping contribute towards your home purchase. So that's absolutely allowed. Okay. Now, let's talk a little about savings for home ownership. I want to give you a really simple plan to get there. And this is kind of how we plan for home ownership. And so if we were meeting with a client and they're paying $2,000, let's say a month in rent, but based upon their new income, they just started a new job, they're feeling really good, their cash flow looks really good, and they feel like they can pay, let's say, $3,500 a month in mortgage, but they just don't have the savings right now. What I would encourage that client to do is start a savings plan day one, which is, when I make my landlord's payment or rental payment on November 1st, I'm going to go ahead and pay my $2,000 in rent, but I'm also going to kind of bake in paying an additional $1,500 into my savings account, right? So I'm actually like paying $3,500 to myself or $1,500 to myself, but $3,500 in total. And I'm building up that savings account on a monthly basis. At the end of 6 months, I have $9,000 in that savings account. By the end of a year, I have $18,000, not even taking in consideration high yield accounts that we can get access to. So that's a great way of creating the discipline of, saving, but also preparing myself to be able to take on that new expense of home ownership. All right. Okay. We're going to talk a little bit about assistance programs now. I think most of our audience, and maybe if you just want to drop in the chat, if you're not joining us from California, we can maybe talk about the state you're going to think about buying in. But I think most of us are in California. So I'm going to talk about the CalHFA assistance program and what that can look like as a resource for you. I did have a question come in the chat, which I think I hit on this, but I'll go backwards again on this. So are you similar to a bank is what the question was. What are the differences between having mortgages with banks, credit unions versus having a mortgage with you? So when you work with a bank or a credit union, it's kind of a more of a, I guess a number relationship where you're kind of just the next customer in line kind of a thing. Whereas when you work with a lender like this, it's much more customized. Banks and credit unions are not going to take the time out to educate you and take you through a one-on-one strategic planning process for home buying. It's more like, do you qualify or do you not kind of a situation. Now, in our world, we are a mortgage banker. We're a direct lender. So we lend our own funding mechanism. So you're working directly with the source of the funds, but we're just much more customizable because we're working to strategically plan for home ownership for you. It's not just, do I qualify for a mortgage? Do I not? It's more like, how do I build a plan for me to make this a really great financial decision? All right. Hopefully that answers your question. And then there's rules around earnest money or the question around earnest money deposit. We're going to talk about that in just a little bit. So we'll table that. I think Ken's going to give you a direct answer there. But to keep us on track, let's talk about first-time home buyer programs in California. I don't think, from what I saw in the chat, let me know in the chat if you're joining us outside of California, and I'll kind of comment on other states' programs because we are a nationwide lender, but I think most of us are in California. So CalHFA is one of our partners that we work with. CalHFA stands for the California Housing Finance Agency. They just celebrated their 50th anniversary just a few weeks ago, but it's designed to help low to moderate income households in California. Moderate means up to 150% of the median income. So it's a very inclusive program. There's a program like MyHome Assistance that provides up to 3% of your sales price on a conventional loan, 3.5% for an FHA loan. It's essentially a separate loan that we create for you at a 1% simple interest rate. No monthly payments required on it. In fact, you don't have to pay it back until you either sell your home or if you were to refinance in the future. Now, that will help cover the minimum down payment for those products. If you needed more resources, there's the MyAccess program that gets you up to 2.5% of your loan amount, also at 1% simple interest financing, no payments made until you sell or refinance. And then MyAccess and Zip are kind of interchangeable products that can also help alleviate the burden of closing costs. And then you're going to start to see more talk about this program. We don't have it on our slides, but it should launch in 2026 again. It's called the Dream for All program. It's designed to help support first generational buyers with access to homeownership. It provides up to 20% of their sales price or $150,000. It is a lottery-based program, so I want to emphasize that. It has not launched again yet, but we're going to be in the third year, coming up on the third year of this program. We're proud to be a leading partner of CalHFA and helped with the early development of this program. But stay tuned for more details on that. If that's something that's interesting to you, you can find more information on our website. We'll be kind of putting some more information out on our socials soon. And then I just want to kind of bring to attention, there's the Pathway DPA program. That is actually a nationwide program that we offer up to 5% in assistance for an FHA loan. So there is a lot of great resources out there. And if you're in LA County, I don't have this on slide here, but there's the Green Line program as well too, that allows you to make up to 125% of median income, get up to $35,000 in assistance if you're purchasing in LA County. So a lot of great resources. And I think I bring that to our attention to class because a lot of people think they got to plan 5 or 6 years out for homeownership. It doesn't necessarily need to be the case. It could be a lot shorter of a goal given the resources that you have access to. With a scenario of traditionally buying, I have this on screen here. So if you bought, say, a $700,000 home today with 3% down of your own funds and put your own closing costs and prepaid items out of pocket, you probably need about $35,000 to $42,000 today. But if we were to kind of insert, let's say, the MyHome Assistance program, you would get another $21,000 in assistance that could help offset your down payment requirement. And then maybe I only have to worry about closing costs out of pocket. Or if I need even more resources, I could, essentially get the MyAccess program. And now I have almost $38,000 in resources to buy that $700,000 home. We have countless stories, success stories of first-time buyers that are taking advantage of these programs to really just get their access to home ownership. And they're just really great vehicles to make it so much more of a near-term goal for you. Now, there are eligibility requirements. You can see those on screen. A lot of what we've already talked about in tonight's session, but I do want to point out a first-time buyer is someone that hasn't owned in the last 3 years. So, if you may have owned a home in 2019 and sold it in 2020, you are still considered a first-time buyer. You can even have a rental property, for example, on the East Coast and have been renting in Irvine for the last 3 years. You're still considered a first-time buyer. It's only good for 1-unit properties for this particular program, like most first-time buyer programs. And you can see kind of the eligible properties on screen. And I also wanted to pass along to you the income limits for these programs. You can see we gave you all the Southern California counties. If you're in Northern California, maybe you're in Santa Clara County, the limits have just upticked. I think it's $316,000 in Santa Clara County now. But ultimately, the maximum income is based upon 150% of the median income. We update these income limits with the state every June. So you'll see a new iteration come out later next year. All right. And Ken just put the income limits for other counties. So if you want to be in Kern County, for example, or San Luis County, whatever the case may be, you can click on that link and see all the counties noted. All right. Well, we're rounding the corner here to the finish line, and I appreciate everybody staying tuned because I think we're getting to one of the most important parts of our class, which is like, where do we go from here? Like we've learned hopefully a few takeaways from our class, and I want to kind of figure out homeownership. Where do we take this from here? Well, we would encourage you to get connected with us for that one-on-one consultation. That's where I meet with every person that attends class that wants to kind of meet with us for a 30-minute virtual session just to design some options for you. And as we figure out what a plan looks like, then we kind of have everything built and we can decide if we want to start looking for homes or if we just, hey, we want to let that plan kind of simmer for a little bit, and then reevaluate this a year, whatever the time frame is from now, right? So the output of a consultation is a pre-approval. That allows you to go out and start actively shopping. Pre-approvals are good for 60 days, but I share that with you not to create urgency, but just to let you know there is a timestamp to it, but we can always recertify it at any time. So you don't have to worry about feel pressure to buy. You have 2 years that your application stays active with us. And as a reminder, we only do a soft credit check when it comes to your application at this point. Step 2 would be the house hunting phase. So it probably starts online, and then it moves to in person. We'd always encourage you to connect with a realtor in your local community that you want to buy in. We have a list of preferred realtors that we work with all across the country, whether you're going to buy in Irvine or you're going to buy up in, Culver City. We have, preferred realtors in those markets that we trust and the experiences they create. So we can always connect with you. But I would encourage you to talk to a realtor just to get a sense of what the market looks like for you. And they should be a well-respected realtor that understands, not only what you're looking for, but have colleagues that they can lean in on for like different listing options that maybe fit what you're looking for in your home search. Now, as you're going out and looking at homes, you may find the home that you love and right from day one, and you say, hey, I want to make an offer on that home. Well, not likely that first offer gets accepted, but let's say it does, right? You get your offer accepted, then you're going to move to step 3 in the process, which basically means you have a ratified contract between you and a seller. And that contract that you've ratified has some timelines to it that say you have certain milestones that you're going to have to perform at. Now, the closing date is usually in most markets 30 days. It can be 21 days. It can be as short as 14 days. We have some of that in some of our more competitive markets, but ultimately, it kind of tells you when you're going to become the homeowner, right? So when we go from step 3, which is entering escrow, to you'll see step 6, that is the time frame of the escrow period. Now, the same day that you get your offer accepted, you're going to get a call from me saying, hey, congratulations, you did it. Your offer's accepted. Let's walk you through some next steps, and let's schedule you for a virtual session so we can go through all the ingredients of your loan. You'll also have action items like making your earnest money deposit towards your home purchase. And I think we had that question come up. In most markets, it's like 1% to 2% of your sales price. Sometimes I see in LA County, even Orange County, it can be as high as 3% of the purchase price. That money ultimately goes towards your total out-of-pocket expense. That earnest money deposit can be taken from any one of those asset verification sources that we talked about earlier. So there's no issue with that. It can't be cash, but gift funds can also be used for an earnest money deposit. What's important about the deposit is that it is protected by contractual contingencies for these 3 areas. And not all contracts have these. You have to negotiate this with the seller, but you have your appraisal contingency that basically ensures that your house is worth what you're buying it for. You have a inspection contingency, which your realtor will help organize and set up those inspection dates that allows you to kind of see what's going on with the house. And then your loan approval to ensure that your loan gets approved in a certain amount of time. For the most part, contingency periods run anywhere from 7 days to as high as 17 days. And so within that time period, you can do your investigative or research work on the home and make sure it's a good investment for you. As we kind of push through the workflow, step 4 is kind of more the administrative stuff. It's more verifying your employment on the loan side, income, assets, all that stuff gets handled there. Again, we are meeting with you for a virtual session before this all takes place. We are going to get disclosures out to you within 72 hours of your ratified contract or after connecting with you for your follow-up video session. And you get iterations of disclosure sent to you throughout the process. There's initial disclosures, there's redisclosures after you've locked in your interest rate. And then finally at step 5, which we're going to go to now, you get a final closing disclosure. It is important to understand as a buyer that once you go under contract, then now we start talking strategically about when to lock in your interest rate. So as you heard earlier in our interest rate segment, like interest rates are quite volatile, but we do see the trend of going lower. We're going to have some strategic conversations on how we time locking your interest rate to take advantage of the best price opportunity for you. Now at step 5, we have your loan approval. We have your appraisal probably back by then. Your inspections are done. We're probably about 2 to 3 weeks into that process. And by that time, if everything checks off, then you can sign off on your contingencies with your realtor. It also positions us to send you out your final closing disclosure, which essentially gives you a 3-day cooling off period before you get to the very final stage. It's called closing the loan. And that's the one in-person stage in the process. Everything else is done virtually or e-signature. but you'll be signing documents with a public notary. You also will contribute your final funds at that time. And as your lender, I'll be wiring in your funds for your mortgage, maybe some assistance products that you're going to elect. And those monies get all reconciled by an escrow team. And then once they have those funds, they record documents with the county recorder's office. They'll record a grant deed to transfer ownership to you, as well as the deed for the new mortgage. And once we get confirmations that those are all back from the recorder's office, then we get a chance to call you and say, hey, congratulations, you did it, high five. You're now a homeowner. Huge accomplishment. I get a chance to make one of those calls at least once a day, and that's the best part of my day, next to teaching the class, of course, because it's a huge accomplishment, and it's a big financial milestone for our clients. And so our relationships don't end there with our clients. Just like I mentioned to you, I was talking to a fellow UCI alum earlier this evening, because we're always staying connected with our clients in our aftercare, because we want to make sure we're monitoring what's going on with interest rates through our rate watch program if it ever makes sense to refinance. We have tools like our HomeBot system so you can track your home equity. And we're always checking in with our clients on an annual basis, because let's face it, things are always changing for ourselves financially, right? So we want to make sure that you're in a good spot and you understand your home and it's working for you properly. All right. So that's kind of workflow of buying. As I mentioned, we would love to get connected with you for a one-on-one. If you're interested in getting started with us at any time, I've provided some of the links to that. You can see it starts with a really simple online application, really super easy. It is a soft credit check. You do upload some documents, and then you use our scheduling system to select your virtual session with us. And I meet with every one of our clients to make sure they're getting all the information they need, all the tools and resources to map out a great plan for them. And this is kind of what that plan looks like. You can take a look at it when you have time. But ultimately, we're just designing that roadmap or maybe even a blueprint to home ownership for you. Now, as part of our partnership together in home ownership, we provide a lot of great technology to you. We can work through mobile. We know we have a lot of great tools like you saw with HomeBot. We try to leverage technology the best we can, but it doesn't replace the human touch. And that's a big side of our business, which is staying connected with you on phone or email or call, text, whatever it takes to make sure that you're getting the right information to make sure you feel good as a client working with us. All right, and then I made mention of this earlier, which is our UCI partnership discount. So we discount our services by $750 for our closing costs, either on a purchase or a refinance. And we have similar partnerships spread out across the country. We have 16 different alumni associations we work with. If you have friends, family, or coworkers that you think would love to hear more about this content, we have more live sessions like this left on the calendar for 2025, and we'll probably teach over 10,000 people home ownership this year and into 2026. So, feel free to have them join one of our classes. They are open to the public. And of course, like we're recording this class, this will be up on our YouTube channel for you tomorrow as well, too. All right, here's all my contact information. So feel free to reach out to me if you do have any questions. We'd love to be able to meet with you for one of your sessions. And finally, we try to put good content in our socials. So if you want to check out what we're doing on Instagram, you can follow us at JMaida Mortgage. But we also share a lot of our client testimonials there, and a lot of what our clients are saying about us, whether it's on Google or some of it in the Reddit world, because I think we're looked upon as experts in first-time home buying, and we really lead with care in our clients. And I hopefully you get a chance to experience that as you take those next steps in home ownerships with us. Okay, so that brings us to the end of class. I'm finishing with 1 minute to be able to get you guys out on time, but I do want to stick around for questions, and I think we have a few of them going across in the chat. I know Ken's communicating with one of our guests in there, so let's answer any questions we have, and then we'll stick around as long as we need to. So there's a good question. So question was, is APM going to be the loan servicer after lending closes? So great question. So in servicing in the mortgage world, it really just depends on the product. Some of the stuff we do retain. Sometimes we also contract out with third-party servicers. For example, on the first-time buyer program, there is a exclusive servicer for that that's contracted through CalHFA. The difference for our team is that, whether you're servicing by ABC company or another servicer, our team remains your point of contact. So whether that's a question about your property taxes or your homeowner's insurance renewal didn't get taken care of, or you just have a general question about your mortgage, our team helps facilitate or answer any of those questions for you. All right. And Ken, thanks for adding on to that too. All right. Any other questions from our audience tonight? Okay, I think we got someone that had a question about how to do a pre-approval. So we got you all the get started information there. So that's all part of that online application, the upload of documents. And then, like I said, you'll just schedule your virtual session with our scheduling system. Okay. All right. Okay. Well, I think we did it unless anybody has any questions. We are out of here at 7:01. Thank you so much for your time this evening. Hopefully I get a chance to meet with all of you in the coming weeks. And hopefully you enjoy the rest of your week, and I will talk to y'all soon. Have a good night.